This is strategic hedging with options and futures, the Micro E-mini Russell 2000 futures contract. The Micro E-mini Russell 2000 futures contract, symbol /M2K, was introduced on May 6, 2019 by the CME Group. The Russell 2000 index is made up of approximately 2,000 small cap U.S. companies. It's widely viewed as a benchmark for the performance of smaller businesses and often moves different than large cap indices. M2K was designed to give retail traders affordable access to small cap market exposure. The tick size for the Micro E-mini Russell futures contract /M2K is 0.10 index points, and the tick value is 50 cents. In order to calculate the value of 1 full point, we take 1 divided by 0.10, and we get 10. This is how many ticks is in 1 full point. We then take 10 and multiply that times the tick value of 50 cents to give us a 1 full point value of $5, which is the contract multiplier. In order to calculate the contract size or notional value, we multiply the value of the M2K futures contract by the contract multiplier of 5. And another way to think about notional value is to recognize that one M2K futures contract is equal to 50 shares of IWM. So let's hop into the thinkorswim trading platform here to calculate the current contract size or notional value for the Micro E-mini Russell 2000 futures contract given today's prices. The current price of the front month contract of /M2K is $24.13. We multiply that times the multiplier of 5 to get the value of one contract, which is equal to $12,065. Now let's see how this relates to IWM. In order to calculate the notional equivalent, we take $12,065, which is the notional value for one futures contract, and we divide that by the current share price of IWM, and we get a value of 50. Which means that 50 shares of IWM is notionally equivalent to one Micro E-mini Russell 2000 futures contract. The Micro E-mini Russell 2000 futures contract trades nearly 24 hours a day, Sunday to Friday, between 5 p.m. and 4 p.m. Central Time, with a maintenance break between 4 p.m. and 5 p.m. The contract expires quarterly, every March, June, September, and December, with most trading activity concentrated in the front month contract. A word about margins. To place a futures trade, I only need to put up the required trading margin, which is much less than the full contract value. Margin is the amount of money a trader must deposit in order to open and maintain a futures position. There are 3 types of margin: initial margin, maintenance margin, and overnight margin. Initial margin is the amount required to open a position, and maintenance margin is the minimum balance required to keep a position open. If the account falls below maintenance margin, a margin call occurs. And finally, overnight margin. Some brokers have separate, often higher requirements for holding futures overnight, and you always want to confirm your requirements with your specific broker. Now let's hop into the thinkorswim trading platform here to see what current margin requirements are for one Micro E-mini Russell 2000 futures contract. I have the futures highlighted in the drop-down box here, and we can see that in order to trade one futures contract, we would need to put up $1,199.99. So what are the advantages of trading the Micro E-mini Russell 2000 futures? Well, first is leverage. You can control a large notional value with a relatively small amount of margin. Next is tax efficiency. In the U.S., these contracts enjoy 60/40 capital gains treatment via Section 1256 in the tax code. And if you have questions about this, consult your tax professional. These contracts have extended trading hours. And finally, hedging. M2K can be an instrument for portfolio hedging. A word about risk management. Risk management is crucial when trading futures due to the leverage involved. You want to be cognizant of position sizing and consider using stop-loss orders, and of course, market awareness. You want to be sure you know what's happening in the market before entering into these positions. In summary, the Micro E-mini Russell 2000 futures contract provides an affordable and accessible way to trade or hedge exposure to small-cap U.S. companies. With lower notional value, tax efficiency, and extended hours, /M2K is another tool for traders looking to diversify beyond large-cap indexes. This video is for educational purposes only and does not constitute investment, financial, or trading advice. No recommendations to buy or sell securities are being made. All examples are hypothetical and for illustration only. All investments carry risk, including the possible loss of principal. Options trading involves significant risk and is not suitable for all investors. Past performance is not indicative of future results. Consult a qualified financial advisor before implementing any strategy and review your financial situation, risk tolerance, cost, fees, and tax implications. Options trading requires broker approval, and not all strategies are permitted in all account types. Returns shown are hypothetical and not guaranteed. Market conditions may change quickly, and results will vary based on market performance, timing, and execution. Read characteristics and risks of standardized options from your broker or at www.optionsclearing.com before trading options.